Welcome to the loan officer training with the mortgage calculator. Today we're going to be talking about calculating and evaluating borrower income. We'll wait just a minute here to get started. We put the chat up on the screen there. Feel free to drop a comment there in the chat as you tune in. I see comments already coming in. Appreciate it. We'll get started here in just a moment. Thank you everyone for tuning in from all the different platforms, YouTube, Facebook, LinkedIn, Spotify, Apple Music, everybody tuning in on all the different platforms. We appreciate it. All right, I see some comments coming in there. Thank you. Thank you. Good evening, everyone. Just waiting a second to go live on all the different platforms and let everybody have a chance to jump on here. All right. All right, it looks like we are live on all the different platforms, so we can go ahead and get started. Keep dropping comments there in the chat as you tune in, and feel free to drop any questions you have in the chat as well as we go through here today. So welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We're a correspondent lender that specializes in non-QM loans, and what we do every Tuesday and Wednesday evening at 7 p.m. Eastern is do our loan officer training series, where we do a different training topic. So our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, is going to be talking to us today about evaluating and calculating borrower income. So I think he's got some tax returns that we're actually going to look at and talk about and go through calculating and analyzing some income there. So you can go ahead and get it started, Jose.
Good evening, everybody. So, really excited about today's training. We've been getting quite a few full doc loans coming through the pipe. And I think now, with the great news that we had today, uh, we're going to see further dip in the agency rates, and we should get those borrowers that were sitting on the sidelines deciding to make a move. And some of those are going to be, as I'm already seeing in the files we're disclosing, self-employed borrowers. So I thought this was a great time to go over evaluating and calculating borrower income. We're not just going to be talking about self-employed borrowers. We're going to be talking about borrower income. So we're going to be talking about employed borrowers, those that are salaried or hourly. We're going to be talking about self-employed borrowers, as well as other sources of income. Now you say, what are other sources of income? Well, stuff like Social Security retirement income, Social Security disability income, VA benefits, maybe you want to call that VA disability income, uh, pension, those would be other sources of income, alimony, child support, right? Those are other sources of income. So let's get right into it here. And by the time you all are done, you'll know probably more than 99% of the MLOs know out there regarding calculating borrower income, specifically our self-employed borrowers. So, first, we need to understand what are the key components of income, right? As I was just going over the different categories, we have employment income, right? That is our borrower who's an employee. They could be making hourly wages. They could be making annual salary. Um, we have to consider obviously overtime and bonuses or variable income, and the stability of the overtime bonuses and their hourly in general. We have self-employed income, which is going to be concerned with the profit and loss of the business. You're going to need tax returns and financial statements. And you're going to also have to review business sustainability, right? Just because they have the money to have paid in the previous fiscal year may not mean that they have the liquidity to keep doing so. And then the other sources of income, like I was just mentioning, rental income, right? Also known as Schedule E income, even though rental income is not the only Schedule E income, as I'll show you in a minute. We have investment income, which could be from interest, or it could be from royalties, or it could be from the selling, the buying and selling of stocks, for example. Those are all form of investment income. And then the other ones we touched on: alimony, child support, and all the other type of support payments, right? Disability and different types of support payments. So, what type of documentation requirements are we going to be facing? Because here's now where it starts getting a little tricky. And if you don't understand the documentation requirements, you're not going to ask for everything that you need. And then, excuse me, and then your income assessment will be inaccurate. So for employed borrowers, that's pretty easy, right? We need their pay stubs, right? Because we have to use year to date figures. So we're going to need usually 30 days worth of pay stubs. Now, for those employed borrowers, we're going to have to worry about variable income like overtime, tips, commission, bonuses. So those usually require 2 years documentation and or a guarantee that the variable income will continue if we have documented 1 year but less than 2 years of the variable income. So that can be a challenge, as you know, when you're looking at the pay stubs and you see overtime or you see bonuses and you only have the current pay stub. You just have to understand you're going to have to do a little bit more vetting on the variable income, right? We like to have our MLOs ask for, okay, do you have the last pay stub for 2022? And if you were still in that job, if you're in that job previously, the last pay stub for 2021. Some people do have those. If they're at the same job, maybe they can get it from their payroll department because that's going to show you total bonuses received that year and total overtime received and other variable type incomes so you can easily average them out. You'll need the W 2 forms, 1 or 2 years depending on the loan program, or if you're going non QM, or depending on the automated underwriting findings, right? Usually in automated underwriting, EU or LP, if you have a salaried or hourly borrower that does not have variable income, then there's a good possibility that you're going to get the approval just asking you for the last W 2 and 30 days worth of pay stubs, right? There's a good possibility, even if you do have variable income, you may not have to provide tax returns, but you'll probably have to get a verification of employment that will break down the overtime bonuses, tips, and all other types of variable income that may be applicable. Now, one thing that I want to stress about the W 2s, right? The W 2s are not used to document income per se, right? They're used more to show the continuity of the income, right? So if you had 50,000 in 2021 and you have 55,000 in 2022 and now in 2023 you're on track to make at least a 55 or more, you're okay. Now, if you had 55 in 2021, 50 in 2022, and you're on track at the same job to make 45, for example, in 2023, you're the underwriter will most likely ask for an explanation. And if the difference is usually 20% or greater, there may be some adjustments made there by underwriting regarding the income itself. They may adjust more conservatively if they feel that it is a declining trend. So I stress W2s used more for that. And the only reason I say that is because I've had cases where MLOs have gotten 2021, 2022 W2, added them up, averaged it out, and that's the monthly income. No consideration at all for the year to date pay stubs, which could be showing a totally different story. So be aware what the documents for the employee borrowers are and how they are to be interpreted. For our self employed borrowers, you will need tax returns, at least the 1040s if they are on a Schedule C. If they have an S Corp, you will need their 1120S tax returns. If they have a C Corp and they own 100% of the C Corp, that's a real tricky part now with C Corps, then you will also need their corporate tax returns for the C Corp. If they own less than 100% of the C Corp, then they are not considered the 100%. I mean, I can't really call it an owner, right, Nick? We've had that. We've had that discussion many times with underwriters where they're talking about, well, he's an owner. No, they're owner of the stock. They're not owner of the corporation, but only if they own 100% of the stock of the C corp would then any income or losses be applicable to the borrower. Totally different from an S corp when they only require 25%. Now, I do state these are Fannie and Freddie guidelines. Most underwriters follow these guidelines, but not all, because I've actually had underwriters that follow the 25% rule even with a C corp. That's a non QM business. That's their own prerogative to do so. But did have one outlet that did do that, totally contrary to everybody else. Uh, so remember how when you're dealing with self-employed borrowers, don't just grab the 1040s and now you're seeing action coming from an S corp, from a K1. Don't extrapolate the data from the 1040s. That's the sign for you to ask the borrower for those tax returns. Either it's an 1120S, either it's a 1065 because it's a partnership, or is the 1120 if they own 100% of the stock of the C Corp. If you don't have all of those docs, you don't have an accurate depiction of the income. And if you are past the first quarter of the year, right, they're going to ask you for a profit and loss report as well year to date. So for loans you'd be doing now, you probably would be asking the borrower for like a September or an October year to date P&L. And the purpose of the P&L is not to add income, because it's going to be very difficult to have a positive P&L and have the underwriter accept that income as additional income. However, they will turn around and use a P&L to decrease the income. It's like their prerogative, I guess, to do so if that's really what's going on with the borrower's business. The purpose of the P&L would be the similar as when you're looking at the W-2s for previous years for the employee borrower. It's more to see if the business activity is continuing the same as 2022. If they're on track to make the same, you're okay. If it's less, then explanations are going to have to be provided by the tax preparer and by the borrower to reassure the underwriter that the business is not a sinking ship. Now, for rental income, right? If they own multiple properties, we use the Schedule E on the tax returns, right? The Schedule E on the tax returns is the one that we put rental income on. That's the one. There's also a Schedule E for royalties, but that's not what we're talking about here. We're talking about real estate rental income. So keep in mind that the gross rent amount that's used for calculating that is not the amount they tell you or they gave you on the lease. It's the amount that they put as income on the Schedule E. So Schedule E says $24,000 in rent. It's $2,000 a month, not the $3,000 a month that they may have a lease for, because they may not have claimed the full amount on the tax returns for whatever reason. So that would be the gross rent amount, and then you would be deducting, um, taxes, insurance, and I'll show you a Schedule E calculator uh, at the end of this one. I'm going to show you the income calculator, but just so that you know, Schedule E is the one that you use, and then I'll go over the actual calculations when I'm showing you the worksheet. And then for properties, now this is a real important one because I just had this come up in a loan that somebody was structuring. For properties that the borrower just put into service, properties that are not on the 2022 tax returns, if the customer just put them into service now because they just bought them now, and that's fine, we would just have to provide the lease and the last 3 months of receipt of the rental payments if they've owned it at least 3 months to prove the income. And then you hit them with a 25% haircut, so they get 75% of the income on any properties they just put into service. If they already owned that property, and prior to 2023, then there's going to have to be a good reason why that property was not in the tax return as a rental property in 2022 nor in 2021. Whatever reason that may be, we would have to be able to document that, because if it's not acceptable reason, the underwriter is not going to let you use that new income. So keep in mind, on properties just put into service, not on the previous year's tax return. But we can use those with those stipulations, 75% of the income. And other income is, for example, your Social Security income, where you'd get the awards letter, pension income, where you'd get an awards letter, or not a 1099, but actually a 1098, I believe. No, it is a 1099, a miscellaneous 1099 from the whoever's paying them the money. Um, or there may be some kind of document that you can get from the administrator of the pension if it's something that's not reported on their tax returns. That sometimes is the case. Divorce decree, your alimony income, your child support income can usually be documented by a divorce decree and or a property settlement agreement. So, and they're usually going to ask you for some proof of the receipt. So let's talk a little bit about when you're calculating the income for the employed borrowers. I touched on a few of the points a minute ago, but I'm going to go a little bit deeper into it right now, right? When in doubt, use the income calculator. There is a W 2 income calculator. It forces you to put in the year to date income. It actually asks you to put in, the hourly income, the hours worked, 2021, 2022, just because it wants to show you, here's the hourly, here's the year to date, and here's the average using 2021, 2022 W2 and all the other numbers. That's just to show you trends, because remember, we're always going to go with the year to date income. Now, one thing to note also, we use the gross income, not the net income, right? Any employment gaps on our salary, hourly borrowers more than 30 days will need to be explained. Now, when when we are doing our income calculations, we're obviously looking at the year to date figure, right? Not the hours worked per week times the hourly rate, because that's what some people tend to do. They just go straight to, okay, they work 40 hours a week times $28 an hour, they make whatever that figure is. But maybe that borrower did not work 40 hours every week. That's why we have to look at the year to date income. Something else we have to be aware of is, did they have an increase in hourly pay uh, halfway through the year, right? That's going to throw off your figure a bit, especially if they're on salary. So be aware that if the numbers don't necessarily add up, uh, be aware of what's going on, because if your hourly is higher and they're making a higher amount now, that's definitely something that has to be taken into consideration, especially if you're tight in the DTI. So, real important. And when you're doing your calculations, be aware also if they get paid bi-weekly, which would have 26 pay periods, or if they get paid bi-monthly, which is twice a month, 24 pay periods, or if they get paid weekly, which then would be 52 pay periods. And if we have variable income, which is anything other than their hourly, right? That's overtime, that's tips, that's commissions, that's bonuses, to name the four most common variable incomes. It is usually averaged over 2 years. If we have 1 year but less than 2 years, we need confirmation that it will continue. Now, on the verification of employment forms, that's a section that they can check off on, where it asks, it asks about bonuses, commissions, whatever, and then it asks, will it continue in the coming year? Yes or no. They can hopefully mark yes if it's yes, and then there's even a spot there, and I think it's box 20 or 21, where they can put some additional remarks if they want to elaborate on that. Because I see a lot of times, again, on the pay stubs, people are just running with those bonuses, with those commissions, uh, um, and then with the overtime, and not considering, did this occur last year? Is this just started now? Is this, is it less this year than last year and the year before? So those are things that get taken into consideration, because when the trend is down, remember, when we're looking at 2021 and 2022 income, this is very important, whether it's an employed borrower or a self-employed borrower. If 2022 is higher than 2021, you cannot average then the higher 2021 with the lower 2022. If 2022 is the lower number, then you'd have to use the 2022 number as the income. So that works out. If you're looking at any variable income, you're going to use the lower. And if it's declining, you're going to have a good reason why it's declining to continue to be able to use it. So uh, remember, averaging anything out, and then on self-employed borrowers, especially in self-employed borrowers, you're averaging their income, their total income. If 2021 is higher than 2022, you got to use the 2022 lower figure. You cannot average them out. So I probably got a little bit ahead of myself here, but when we're calculating the self-employed borrower, we really have to be aware of the business types so that we know the documents to request. So again, determine business type. So if they are a sole proprietor, that means somebody that's not incorporated, because you can be self-employed and be like a handyman, not have an LLC, not have a corp, not have anything, and still be self-employed. So that sole proprietor, you're going to request their 1040 and their Schedule C, because that's where sole proprietors uh, report their self-employment income. And you're going to review that Schedule C and the 1040 for non-recurring other income or losses. And we'll cover how to deal with non-recurring other income or losses once we're done here. If the business type is a partnership, then you are going to ask them for a 1040. You're going to ask them for the K1. You're going to ask them for a W 2 if applicable, if you see that there's W 2 income on the tax return. And you're going to ask them for a 1065 partnership report if they have 25% or greater ownership in any partnership, similar to the 25% rule for the S corp. If they have 25% or more in an S corp, you then it's considered that they're vested in it. Let's call it that, and then you have to ask for the tax return. In this case, same. If they have 25% or greater ownership in the partnership, the 1065 report has to be reviewed. It looks just like a tax return. It is a tax return, just a tax return for a partnership. And you need to review that 1065 report because you need to confirm that the business has liquidity to support the income withdrawals, the distributions that they're paying out to the partners, right? Uh, you have to uh, guarantee that they can sustain those payments, right? I mean, what good is it if those trends are decreasing and if you cannot show that there's going to be a consistency of revenue and profitability? That's the key when dealing with partnerships, because partnerships usually exist to pay out the partners at the end of each year, right? So they have to have profit to pay. S corp, you're going to ask the borrower for the 1040, the K1, the W 2, again, as applicable, and the 1120S if they own 25% or more of the S corp. And again, you're going to have to verify the same items are not an issue with the S corp: liquidity, consistency of revenue, profitability, positive sales earnings trends, and the ability to sustain guaranteed payments. And then the last one is the C corp. Now, let me go back a second. In terms of LLCs, usually are only going to come into play when there's a partnership. Usually, the LLC, it doesn't have a separate tax return to report, so any income from the LLC, depending how they handle their business, is probably going to be passed through a Schedule C or through the 1065 if it's a partnership, and then that gets passed on probably to a Schedule C as well. So S corp, we went over that. Okay, C corp. Remember, now this is critical, and this can allow you to win some arguments with the underwriters and not have your deal needlessly denied. Fannie Mae requires, and Freddie requires 100% ownership to use the income or to have the losses counted against the borrower from a C corp, right? So we've had it before. I've had it before. My borrower is less than 100% owner or 100% stake, let's call it that, in the C corp, and we were able to not have to have any of the business activity of the C corp considered against my borrower, because sometimes the corps have big losses. That's just the way they operate. There are paper losses, so you'd have to imagine they could have a couple $100,000 in losses that if they are 100% owner of that C corp, that's going to count against them. If they're not 100% owner or 100% owner of the stock, then that wouldn't count against them, and you can argue the point. So that's a real important point with the C corps, because it happens all the time. Underwriters treat them like an S corp, and they just sort of convolute them, and the conditions that you get are the same as an S corp, but it's not the same when you analyze it. So, and we've been covering this a little bit already, but when we're calculating the employment, what do we do when we're analyzing the documents, right? What are we looking for, right? Well, understand there are two primary goals when analyzing the documents. Besides the actual number is, and we've touched base on a few of these now. Understand the income trend and determine if the income is regular and recurring, right? That's very important for self-employed borrowers and for employed borrowers when we're talking and also bonuses and stuff. But understand the income trend and determine if the income is regular and recurring, and address the adjustments on the tax return to differentiate taxable income from qualifying income. What does that mean? That means the items that we add back, right? And I'm going to cover those in the next slide. They're items that when we're reviewing the tax returns, that's why it's so important to get those business tax returns, because the items that you are able to add back, sometimes adding back hundreds of thousands of dollars to income, to the borrower's income, are not on the personal tax returns. The personal tax returns just shows the net. It's like this is what was there after the dust settled, but you need to see the evolution to get to that number so that you can add back uh, different fields that you can add back. But I don't want to get ahead of myself because I got a whole slide for that. So, what are the important items to consider when we are reviewing and analyzing and differentiating? Well, again, look for declining income and a loss for the year and determine if it is a one time event or recurring. Now, I've had this happen, and where there's a paper loss, right? They have the business maybe had a big loss 5 years ago, and maybe the tax law lets them amortize that loss over 5 years, 7 years, 10 years, because you may have a limited benefit if you try to write off the complete amount in 1 year, but you can get more benefit if you just write it off a little bit every year. So any loss that shows up like that, that's a carryover loss, you can discount away as a loss. You just need to get documentation from the accountant, simple letter. This was a loss for whatever and whatever fiscal year. It's a carryover loss. It's a non-recurring event, and then that loss will be added back to the income. Mortgages, notes, and bonds payable in less than 1 year, right? Those are large debts payable this fiscal year, and that those amounts are usually subtracted from the income unless documents can be provided that the debt will roll over or the business has liquidity to cover the payment. Now, what do they mean by that? Okay, I'll explain a little bit here. Roll a debt that would roll over, for example, would be a business line of credit that you can show that it's not actually due and payable before the fiscal year is up. You can show that is rolled over every year. Sometimes it's 30,000, sometimes it's 60,000, whatever it is. The borrower probably have to provide some documentation, maybe some statements to show that. But a line of credit, a business line of credit, is a very common debt that's rolled over. And the other one, we're just talking about liquidity. Does the business have the assets to cover the debt if it actually has to be paid off? Right. That's where you do the liquidity test. Assets minus liability. They got to cover the debt, or else they're going to have a problem there. We talked a little bit about recurring losses or income. Are the losses paper carryover, or losses due to, or are they actually losses due to a decline in business? And conversely, if it's a non-recurring income, again, if it's just a one-time income, it may look good, but unless you can prove that it's going to recur, then you're not going to be able to use it. If you can prove it's going to recur, then you can use the income. And likewise, if you can't prove that the loss is not going to recur, then they're going to count the loss against you, one or the other. We talked about business returns must show adequate liquidity, which is what we've been talking about in all of these important items to consider. And another thing is you're going to review the Schedule K1. You're only going to have 2 years, right? 2021 and 2022. And you're going to review it to see how the distributions were. That's usually box 16D, as in dog. 16D is the box for distributions in the Schedule K1. If you had a lower amount in 2022 than you had in 2021, that could present an issue, right? Uh, Now, something else we haven't gotten into, but I will touch base on it here, is Fannie Mae versus Freddie Mac, right? Because we're talking about liquidity, right? And we're talking about Schedule K1. And this is, if you take away anything from this, remember Freddie Mac is more lenient to self-employed borrowers, and that has to do with how Freddie Mac views ordinary income and distributions. Because, for example, I'm going to give you a scenario here. You have a K1 with $100,000 in ordinary income claimed by the borrower, right? So he's telling Uncle Sam, $100,000 is my ordinary income. But that's box one. But box 16, D as in dog, only has $20,000 in distributions, right? Now, most people will just, just gloss right over that, and oh no, the income's 100,000, and they'll put 100,000 in the income worksheet, even though if they read the instructions in the income worksheet, it's going to tell them to do differently for Fannie Mae, right? So if this is a Fannie Mae loan, your borrower's income is $20,000, not $100,000, because the distributions are lower than the ordinary income claimed. And Fannie Mae says, I'm sorry, but you got to use the lower figure if distributions is lower, because that's what you actually pulled out of the business. Excuse me. Now, Freddie Mac says if the business has same borrower, $100,000 ordinary income, $20,000 in distributions. Freddie Mac says, I will let you use $100,000 as the income if you can show that the business has liquidity, right? So then you do your liquidity test, Form 92, in the Freddie Mac forms. Form 91 is the income calculation form. Form 92 is the liquidity form. And as long as you show there's liquidity, assets greater than liabilities, basically, then you can use $100,000 as the income instead of $20,000, which is the distribution. So that's a big difference, and that's really why you would use Freddie Mac instead of Fannie Mae for a self-employed borrower. It's not really about the rate to begin with. It's about what is the income if you're faced with that kind of a situation. So, real important. Definitely need those K1s, right? Definitely need all the documents that we've mentioned here to do an accurate analysis of the income. So, and now we're almost done here when we're calculating our other income sources. So, keep in mind the following: Schedule B is used for interest and dividend income. So for anything like that, you're going to need a 2-year history and a 3-year likelihood of continuance. So that documentation is going to have to come from somewhere. So it all depends where that interest and dividend income is coming from. You're going to show a previous track record for the borrower that she's been doing this for years, and then hopefully they have a sizable portfolio where you can show that they're just not going to liquidate. So 3-year likelihood of continuance and 2-year history are really important. Schedule D is for capital gains and losses. Now, in most cases, a capital gain is a non-recurring event. Like you sold a house. Like you'll see in Kamala Harris's tax return in a minute. They sold a house in San Francisco. They had a big capital gain, but the following year there was no Schedule D because that was a one-time event. So you wouldn't use that income into their total income. Schedule E, I mentioned, is for rental real estate, but it's also for royalties, partnerships, S corps, estate, and trusts. So, rental, keep in mind that on the income calculator, there's a Schedule E section, but that's not rental income schedule E. That's royalties and the other partnerships and S corps and stuff. Rental real estate schedule E is calculated on a separate form, actually form 92, which I'll show you guys in a minute. And we discussed properties just put into service, not on the last tax returns. We can use 75% of the lease rent as long as the borrower can provide proof of receipt of the last 3 months' rent if they've owned it at least 3 months. If they haven't had it at least 3 months in service, then proof of the lease deposit and however many payments that you've taken in for the underwriter to consider giving you 75% of that lease amount. And then any royalties are calculated in the Form 1084 or the Form 91. Schedule F, which is a schedule for profit and loss from farming, again, determine if the income is recurring. Social Security, disability, VA benefits, and any other type of support payments use the current awards letter amount. And alimony and child support use the divorce decree and proof of receipt of the last 6 months because that's a non-taxable income. So you'd have to show that you received it for at least 6 months to get 100%. So key adjustments. We talked about adding items back. Key adjustments and how they affect underwriting. So business use of the home, we add that back. And the reason we add that back is because we are already considering the borrower's housing debt in their DTI. So if they're claiming part of the home for business use, the IRS lets them do that. And it's that way we're not double charging the customer. Let's just say that's the theory that the IRS uses to let the borrower deduct that, and the underwriting theory for why we add business use of the home back to their income. Non-taxable income, like what I just mentioned, just because it's not taxed doesn't mean we don't use it if it's available to the borrower and if we can document it according to the guidelines. Non-recurring income losses would be added back depending on if it's an income or a loss, but they should really not be used in qualifying the borrower. Really, the purpose when you see a non-recurring income or loss is just to negate it. Just find a way to negate it, and so it doesn't come into play, because usually what you're going to be trying to negate is the non-recurring loss and not non-recurring income. We discussed guaranteed payments, so you need to confirm profitability of the partnership before considering guaranteed payments and adding any of those back. Depletion is a paper expense. I actually saw depletion on a tax return today. You rarely see that. It's not no actual dollars were spent, and underwriting guidelines let us add depletion back, but it has to say specifically depletion. Depreciation is another paper expense that we can add back, and amortization. In amortization in this term, it means business startup expense. This is not the amortization of your loan. So again, paper expense, you can add it back. Now let me comment on a couple of items that you all will see on the income calculator worksheet that people tend to add back mistakenly, right? Uh, Property taxes and property insurance, right? The only, and that's listed on the form, and it has a plus by it, meaning you add it back, but you only add it back if the borrower is escrowing for taxes and insurance in their monthly payment for that property, whatever property it is, right? Because when you're doing the Schedule E income calculator, that's one of the items that gets added back, taxes and insurance. So if they're escrowing, they've provided you a mortgage statement, and you can see clearly there that for property A, it shows taxes and insurance included with the monthly payment, then you're not going to hit them double for the item. It's already included in the monthly payment. So you're going to add the amount back to the income, right? To get a an adjusted amount. But you only add them back if they are actually escrowing for those items. Many times I see they're not escrowing, and then somebody has the item added back, and then we got to take it out, and now all of a sudden we got $1,000 a month difference or $800 a month difference in the income, and that actually makes a difference in some cases. So, in a nutshell, then, what are the challenges to evaluating income? And this is going to be pretty obvious answers after all the items that we've gone over, right? Inconsistent income streams, right? Gaps in employment for our salaried borrowers, business less than 2 years in existence for our self employed borrowers. You could have over a variable income that's not there in previous years. It's only there this year. So again, that's another inconsistent income streams. You could have income that is seasonal. So now you're going to have to prove that it's seasonal every year. And there is seasonal income, definitely depending what part of the country you're in. I mean, some parts of the country that are blanketed with snow in the winter, I would imagine some business activities are curtailed quite a bit, like land, the lawn service person, and the roofers. If all the roofs are covered in snow and all the lawns are covered in snow, there's no action going to go there. So you would have to show a seasonality through multiple years for underwriting to be able to consider those incomes. We were just mentioning that, right? Self-employed borrowers with individual with irregular income and bonuses, commissions, and other variable income. If it's the large part of their income, that's going to be a challenge moving forward to confirm that that's actually going to happen. So now let me share with you all the income calculators that I was talking about here, just so you can have an idea and what we're talking about. And then I'm going to show you Kamala's tax returns a second and how I reviewed her income. So notice here, let me make this a little bit bigger. Now this is
Can you
Freddie Mac.
do full screen on the browser? And the little three dots. Yeah, do the full screen there.
Which one is
It's
it?
next to Zoom. Yeah, right there. Now you can make it bigger.
All right.
There, much better.
All right. So you see here rents received, right? Now notice 2021, 2022. Remember we talked about averages. You can't go with a high, average out a higher 2021 and a lower 2022. Rents received is going to be the amount they claimed in the tax return in the Schedule E. You don't put what they have on the lease there, the monthly, and multiply that times 12. It's the actual amount they claimed. Total expenses is going to be like it's even telling you what line to go to on the Schedule E. Go to line 20 on the Schedule E. This one here tells you go to line 3 on the Schedule E for rents received. Less total expenses, go to line 20. Right, that's going to have everything: your depreciation, the repairs, the utilities, all the stuff's going to be in there, and then you get to add stuff back. Line number 9, insurance, you get to add back if they're escrowing for taxes and insurance. You don't get a freebie there if they're not escrowing. Mortgage interest, if it's listed in line 12, you definitely add that one back. Real estate taxes, again, only if you can show that they're escrowing already. Depreciation, you definitely get to add that one back. Okay, and HOA, another one, and then here we have our one-time losses. Now this is a very, very interesting category, the one-time losses. Because if, for example, let's say in your expenses, right, that 1 year, man, it showed a big loss because you had to replace the roof, right? You don't replace a roof every year. You replace a roof maybe every 15 to 25 to 35 years, depending on the type of roof that you have and no hurricanes came through or anything like that. So if you can show, hey, you got to add back the $23,000 in expenses here because that was a roof replacement, and you can show your roof contract and proof of payment, you are going to be able to add back that one-time expense. Here, they have one-time losses or non-cash deductions, such as casualty loss or amortization, which is what that's for. We talked about those, but you can also put there what I just mentioned there, that one-time loss. So let me go back where I was. Okay. Now, this is our income calculator. Let's get full page. Full view here. Okay. So notice again, this section here, I want to explain clearly, this is for W-2 income from self-employment. Now, I want to touch base on this because we get many instances where there's confusion because the borrower says, "Oh no, I work for John's, whatever company, and I'm W-2, but they're actually one of the owners. They have more than 25% or more ownership in the company. Yeah, they have W-2 income, but they're not an employee of their own company. They are self-employed, and they are paying themselves W-2 income. This is the W-2 that they're referring to right here, is when they're self-employed paying themselves W-2 income. This is not W-2 income from a real job, but W-2 income from their company. That's why it says W-2 income from self-employment, right? So that's what goes here. And then this Schedule B, interest and ordinary dividends, is from the business. This is not the Schedule B that I was talking about earlier from the 1040, because the business could have interest and ordinary dividends, big time business. Now you have Schedule C. You could have more than one Schedule C, by the way, and you'll notice the items here: net profit or loss, non-recurring other income or loss, line 6, depletion, line 12, depreciation, line 13. Notice that has a plus by here, so it's added back. Meals and entertainment exclusion, that's a minus. Notice that says this showing you right where to go to, line 24, B as in boy. Why is that a minus? Well, the reason that's a minus is because the IRS lets us deduct 50% of meals and entertainment, which means that there's 50% out there that's an expense that we had to face. And they know that. So they hit us up right here with the other 50%. That's the minus for meals and entertainment. And then amortization or casualty loss has to say the word amortization, or it has to be a casualty loss. That's an insurance loss that wasn't covered, like an out-of-pocket loss that you had to cover. That's what that would be. So only add back amortization or casualty losses. That's what it's saying there. Business use of the home. That's either on the Schedule C or line 30, Form 8829. Now, again, that's rarely ever. I mean, we do see it, but that's one of those deductions that I would think twice before using it, because claiming it, because that's one of the biggest red flags for IRS audits. Business use of the home. Business miles, which is also going to be on the Schedule C or in the Form 4562, which is the depreciation schedule. So it's either line 44A or line 30 of Form 4562 is going to be any business miles. And then 26 cents a mile for 22, 26 cents a mile for 21. That's your total mileage depreciation. That's your total from your Schedule C. And that's if there's another business Schedule C. Schedule D here is for the business, again, not from the 1040. Remember I mentioned Schedule E? It's for royalties in this case, not the Schedule E rental income. So it's telling you where to go in your tax return, either line 4, line 20, line 18, and then you get the bottom line. And then Schedule F from farming. And here is the K1, ordinary business income loss, net rental income, guaranteed payment, subtotal, partnership income. So you can see all of these. And then S Corp, again, similar things. Just all the different lines, tells you exactly where to go. But this is from the 1120S. And this is from the K1 from the 1120S. This is if they are 100% owner of the stock of the C Corp. And we actually had one come through where the husband and wife were 50-50 owners of the C Corp. So losses or income would be applicable. And then here, system recaps everything. And remember that you only average out. Here's where they let you do your decision on. Notice it has total stable monthly income, or it has total alternate calculation if you're going to go with anything other than the average of the 2 years. So let me show you a minute now what I did with the tax returns. Okay, we're going to look at the tax returns in a minute, and then I got a little breakdown of it. There's a lot of pages, but not a lot to really go over. I just want to touch on the trends. So I want you to notice here now what they had, right? A lot of numbers here, right? You start looking at these numbers, 1,598,000, and you're gonna think, wow, that's their income, but that's not their income. They have W-2 income here. They have Schedule B income here. They have Schedule D income here. This is the sale of the house. This is some interest income. This is W-2 from the Senate for Kamala and from the husband who's a professor, right? And then there's some partnership income as well, right? That they had. So, and a Schedule C. So if you go to the Schedule 1, it says, okay, business income or loss. That's the Schedule C. And then it has rental, real estate, royalties, partnerships, escorts, trusts, etc. right here. Right now, remember, Schedule C has to be recurring, as does the partnership. So that's a very important point, because I want to show you the Schedule C a minute here, and then we're going to go to the 2022. Did I already pass it? No, there's the A. There's the B, okay, the $694 in interest. And the C was writer income, right? I guess book deal, $386,713. Her commission and fees was the deduction. So now 2022 totally changed. This is why we got to look at the recurring trends. W-2 income is about the same, right? There's no change there. But the other income really dropped precipitously, because in our Schedule 1, we only have 62,870. So she only had 457,760 in income versus 1.5 million in 2021, right? And the reason was the Schedule C, and we're almost done, folks. The Schedule C income was very low. She had no interest income. Okay, she had a little bit more, 6,054 versus 694. So we could probably use that. But look what happened with the income as a writer. Went down to 74,772. So to even be able to use this income, since it's such a big drop from the prior years, we need some good documentation to explain why the drop. Maybe she got a big signing bonus, and this is just a regular residual income, and this is more in line with what she would be getting, then we could use it. But if we don't have good explanation and it's like a 60, 70% drop, you might not be able to use the income. And she had no partnership income. So in the end, I got my little summary here. Let me try to make this a little bit bigger for everybody. So this is my little summary that I did and where you can compare. Look at 2021, right? 386 versus 388 for the W2, but then the Schedule B, 694 versus 6,054. That's all good. But we got declining in the income as a writer, and we have no Schedule D income at all. They had no capital gains, so we can't use that previous capital gains. Nor could you use capital gains unless you could really show that it's something that happens every year. And I guess she dissolved her partnerships there or whatever was her interest in there because she claimed none of that in 2022. So if this was my file, we'd be looking at W2 income here and maybe a little Schedule B income and have to get a good explanation to be able to use this $5,200, $5,400 a month income as a writer. All right, so do we have any questions?
There has to be some questions.
Did I do such a great job that everybody just understands it all, or are they just quickly looking through their notes right now to see what they're going to ask me?
I have a question. How'd you get the tax returns?
Whitehouse.gov. Well, actually, you emailed them to me.
Yeah, well, yeah.
Yeah, but it was whitehouse.gov. And then there's actually a link there for tax returns for like Prez, the Vice Prez, and I think even for Congress. You can
Yeah, so good practice ones, guys. And obviously they have a lot of stuff going on. Typically, your elected officials are going to have some sort of business of some kind. So definitely good practice. Tax returns.
Lots of book deals and things like that. All right. I don't see any questions, so I guess we can go ahead and wrap it up. That was a little bit of a lengthy one, but definitely in depth and definitely valuable information. Anything else, Jose, to leave everybody with before we wrap it up?
I just want everybody to know that a recording of this will be out there, and I want everybody to use it as a resource when they are reviewing their self-employed borrower loans. Please remember, it's so important to know the documents to ask for up front. Don't submit an incomplete income file and then 2-3 weeks into the process, underwriter hits you with a bunch of conditions that you may not have the time or the customer may not have them. So be aware so that you don't get caught off guard in your full doc file.
All right, perfect. Well, thank you, sir. Remember, we do this 7 p.m. Eastern every Tuesday and Wednesday, so we'll be right back here tomorrow with a new topic. So thank you, everybody, for tuning in. Thank you, Jose. Great presentation. We'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thank you,
everybody.